Good morning, ladies and gentlemen. Well, still nothing new from the risk dial. Still in a very positive situation, saying that the balance of risks is still to the upside for equities, and the projected path is still very much within the normal bull market. So absolutely nothing new to see there. And the main reason for it is the very low volatilities we're still getting from the tech sector. And until these start rising, there is absolutely no potential for any kind of risk off, apart from a technical correction of a couple of percent. In tech, it might be greater, but overall in SPX, we're talking about technical corrections to the downside as a maximum that we are likely to see in the foreseeable future, with still the bull market continuing. That's what the model is saying, and I see no reason currently to disagree with it. So let's have a look at the dot plots and what the Fed has in store for us for 2024, or what it thinks it has in store for us. Last week I told you that I thought that the dot plot would be at 4.65, and it actually came out at 4.6. So very much happy with my projection. What I got wrong is that they actually lowered the longer term dot plots as well. But let's go in order. So what have they done for real GDP? They lowered the projection for real GDP from 1.5 to 1.4, as you can see, for 2024. They kept the unemployment rate at 4.1%, so they still think the unemployment rate is going to rise to 4.1, and really everything else is contingent on that unemployment rate still going up and the real GDP going actually down. So PCE inflation they lowered by 0.1 for 2024 and 2025. So basically they're saying they're going to be at target by 2025, and they've kept the longer run and 2026 at 2%. So they've slightly accelerated the path of both core PCE by 0.2 and PCE by 0.1. And therefore they have lowered the Fed funds rate to 4.6 in 2024 and 3.6 in 2025. What is interesting to me is that basically they're saying that longer run, the real Fed funds rate is going to come down. Because if you look at core PC now at 2.4 and the federal funds rate at 4.6, that is a 2.2 real. And then in 2025, they're coming down to 1.4, and then they're coming down to 0.9, 2.9 against 2. So they're normalizing the yield curve over the course of the next 2 years, 2024 and 2025, and finally in 2026 they get to a to 0.9 or real, and then in the longer run, because they've got the PC inflation at 2%, they're saying that real rates are going to be at 0.5. So they're lowering their projection of real rates over the next 3 years, let's say, from 2 to 2.2 all the way down to 0.5. So let's first look at real yields, and this is what happened in just after the Fed, because as I've shown you, they think real rates are coming down. I think the natural floor for real rates is in this range here, around 150 to 160. I think it's going to be very, very hard indeed for the market to push lower than that, because the term premium, and we can have a quick look at the term premium, is now well negative, and it could actually come down to these kind of levels, you know, minus 22, minus 23, but I really can't see it coming through there. It's going to be very, very difficult for term premium to become so negative with so much issuance ahead of us in the first and second quarters, and really no end in sight to the supply of duration. So this is probably going to be an extreme. And let's have a look therefore at a chart of TIP, which I think is going to be very interesting to trade next year. So this is a daily chart. We can see that where we were at the beginning of 2023, and we are just a little bit higher than we were at the beginning of 2023. I think that what is likely to happen is that this area is going to be a floor now, because if the Fed's projected path is correct and data does not deny what they are projecting, and I keep on telling you we're more data dependent than ever now. If data, i.e. inflation data and unemployment data, but primarily I would have thought inflation data, does not deny them that path, it's very difficult to see TIP coming below this area here between 106 and 105 and 3/4, call it 105. So this area here is going to be absolutely pivotal. We have the 200-day moving average now actually turning, and I think that any dip into this area is going to get bought big time. And I project that TIP throughout, by the end of 2023, if the data is as the Fed expects, is going to be up here, is going to be around the 111, which basically tells us that the path is going to be for lower rates, but it's going to take time, I believe, because the Fed needs to see the data support it. So I really wouldn't be surprised to see 1 or 2 months of consolidation now before the next move that goes up. But TIP is going to be the one that's going to tell us how to trade this on a day-to-day basis and on a week-to-week basis. I really think that the likelihood of us coming down lower than this range here is now very, very slight, unless we see a reacceleration in inflation, and in which case the Fed's dot plots are a load of rubbish anyway. And let's have a look at the market's response, because futures are now very, very rich. Least of the movement has happened in the 1 year and the 2 year. Naturally, the 3 months did almost nothing, because we need data. The Fed needs to be convinced that the path it has projected actually will be reflected by the data that comes in over time. So the 1 year really is going nowhere, and I would be really surprised to see it below 483. I think we are where we are, and we are more likely to range trade back up towards, where we were before the Fed came out, 502, 503. So another 5 basis points to the upside, and the 2 year as well, around 455. I don't think the 2 year is going to go anywhere without the data confirming what the Fed has been saying. Now, where has the movement been? The movement has been in the 3s and the 5s. And as I've told you, why I believe that the belly is the place to be. The belly is the place to be because if the Fed is correct, that is the area that is going to have the lowest real rate in a couple of years' time. So if you buy 5s, you are going to be effectively having 3s in 2 years' time, and if you buy 3s, you're going to have 1 year in a year's time. And as I showed you, they tell you that at that stage the real rate is going to be around 0.5. So if you are trapped now in the money market yielding you 5.25 and you have the reinvestment risk, where are you going to buy on any pullback? You're going to get out of 5.25 money for 3 months or 1 month or whatever it is that you are rolling, and start looking for 3-year, 4-year, 5-year, maybe even 6-7 years. So you get some duration and you lower your reinvestment risk to match what the Fed has projected. Now, will what the Fed has projected come out to be correct? Who the hell knows? But that is what your natural tendency is going to be. So I'd be very surprised to see the 5-year up above these yields. I think any kind of a move to those levels, to 407, is going to get bought violently by people who are now invested in the very short end in the money markets and have the reinvestment risk. If they look at the dot plots and they believe the Fed, they know now that from a 2.2% real rate on the short end, you're going to go towards a 0.5 real rate in the short end, as I showed you from the dot plots. And therefore, as you run down the curve, 5s in 2 years' time or 3 years' time are going to be 2s. And these 2s are going to be trading on top of Fed funds or very close to Fed funds. Even if there's a 25-30 basis point spread, they're still going to be trading below 3%. So, you are reinvesting money at 4% to make a whole percent on the way down. So I believe that the belly is the place that is going to get bought. And that is reflected in the spreads. You see, you have the 2s, 3s flattening. You have the 2s, 5s flattening. You have the 2s, 10s flattening. Now, is it going to go a million miles? Probably not. It's going to go to something like this, and then, the sheer weight of money is going to stop it. So that should be the natural tendency over the course of the next few weeks until we start getting some real data. And from now on, every inflation print is going to be extremely important, and the market is going to react quite violently to it, because it either confirms the Fed's projected path or it doesn't. And if it doesn't, then we're in trouble. And if it does, then the market knows what its path is. It's one for lower real yields. This same pattern of basically flattening from 2s out is being replayed in Germany. And the real surprise to me was that the one central bank which could afford to be really dovish, the ECB, wasn't as dovish as the Fed. I think the ECB will cut first, and at some stage this curve does disinvert before the US curve. But you can see that the same 2s, 5s behavior, 2s, 10s behavior is being repeated in Germany to a lesser extent. And I think that hasn't got very much more to go. I think this will turn out to be an inverted head and shoulders, and that this will turn out to have been the absolute top in these 2s, 10s, and that at some stage we will be trading a lot lower. So, but for the short term, I think 2s, the Schatz is completely stuck. It's not going to go very far away from here. And any kind of a pullback in 5s to these kinds of areas is going to get bought. I think there is absolutely no value in having puts on the bobble or puts on the 10-year, on the Bund. I think any kind of a move back up towards this 220 area is going to get bought very hard. But do I think it has a huge amount of downside to go? No, I don't think that either, simply because we now need the data confirming where we are. And the spreads between Germany and the US have basically died out. There's nothing happening there. They're in a 10-15 basis point range. I think at some stage they go higher, but I think late December is unlikely the time that that happens. So we are really in no man's land, but the upside in terms of yields I think is very well capped, and any kind of a dip in futures to some sensible level like closing this gap is going to get bought just like it did on Friday, and I think this trend continues. The pressure will be for real yields because the central banks are telling you that they're over time going to reduce the real rate. So I've told you that I think that the yield curve slightly flattens because ones and twos are stuck, and it's the yield curve can only go as far as it can go in terms of flattening, because I don't think it makes new highs on the flattening cycle without very, very strong data. And this is a new tool that the CME has brought out to show you where the SOFR contracts are. And basically all you do is you put in here when you think the rate cuts are going to happen and how big they're going to be, and you press calculate and it shows you where we are on the SOFR curve, what the SOFR curve is predicting, and how far out of whack it is. Well, unless you think that the Fed is going to start cutting in March, which I think the odds are very low, we have this meeting here on the 31st of Jan, and all we're going to have had is basically one decent inflation print and one unemployment. They're definitely not going to cut in January. The odds are that they are not going to cut in March either, unless those numbers are surprises, and then they can maybe start cutting. But look how many cuts are put in here: 1, 2, 3, 4, 5 cuts in 2024, and still the SOFRs are rich. So that tells me that they will probably remain rich. But that tells me that the path to twos going higher in price is very, very limited, extremely limited. And that also therefore tells me that, okay, the curve can flatten more, especially in the belly, as I've talked about the reinvestment risk that people in money markets have, and therefore that they're going to use any pullback to buy 3s, 4s, 5s, in my opinion. But it's still not going to go very far, because even with all these cuts priced, penciled in by me, and no way do I believe all these cuts are going to happen. I think it's more probable that they do a 50 in June and then a 50 in November or December. I don't think they're going to be bothering with all these 25s. You might as well do a 50 if you are close enough to your projected path. You wait a bit more and you do a 50. That's what I would do, but who the hell knows? But even with all those cuts penciled in, we're still rich on the SOFR curve, which tells me again that the likelihood of the twos going is very slight without data. For this to happen and for this to remain as rich as it is, you need data that tells you that yes, we are on the Fed's projected path. And then when you get that data, the market can't go very far because it's already discounted it. So you understand where I'm going with this. We've priced in a hell of a lot, and the only part of the curve that can really move better is something like 5s to 10s maybe. But then we have all the risk of more issuance that comes out on the 31st of January, I believe, is the next QRA, and we need to price that in as well. So I really can't see these markets doing very much unless we get some extreme data. But the one market that keeps on trucking and will continue to keep on going is the spread between the German curve and the Japanese one. This is a huge top, and you are looking for at least that much on the downside. So you're looking for down here. You're looking for another, I don't know, almost 50 basis points. And that tells you that the pressure is going to remain on the euro yen, and we'll have a look at that next. And here is the euro yen. It just can't get above this 158 level, and I think every time it gets anywhere close to it, it's going to get smacked. It's being supported by the 200-day moving average, which is still positive, but I think at some stage it just breaks it, and these are the kind of levels that I'm looking for. At least this 150 area, and really more likely than not these kinds of levels around the 145, 146 in time. This is a weekly chart here, so in time this is what I'm looking for. These previous highs around 145 and a half. I think it's inevitable. I think Japan has basically decided to be slightly more hawkish than before, while the euro and even the US need lower rates at some stage. And I think the pressure is going to continue to be on the euro yen with a target over time of around 145 and a half. I think the likelihood of DXY staying strong is not great, but also I think that DXY is going to be nowhere near as strong as the euro is going to be weak, or the yen is going to be strong. So DXY is going to be somewhere in the middle and not do very much because it's 65% euro. And if we look at what the euro is doing, is basically ranging with this, I think, still being the top around this 110.70 area. I find it very difficult to believe that we're going to go through it, simply because the interest rate differentials are still going to favor the states. I find it very difficult to believe that the states and the German curves come in that much to allow the euro to go higher. I think that we are close to a range top in the euro, and therefore I really can't see DXY going much lower than these kind of levels over time around this 101 area. So that tells me that my triangulation with the Japanese yen is correct. The euro stays in a range, the DXY stays in a range because it's nearly all of it is the euro, and what does go is the yen, and that can continue, and euro yen can continue down towards 145. DBC is really not doing very much, is it? It's so oversold that it's not surprising that it's bouncing a little bit, but this really is nothing to write home about. It's staying towards the bottom of the weekly Bollinger Band, and it really is not allowing any kind of how shall I put it, any kind of inflation fears to develop. As long as DBC stays this weak, and as long as oil is as weak as it is, it's very, very difficult to believe that we are going to have very much of an inflation scare. And don't forget, we do have core PCE out on Friday. And while this situation persists of this continuous weakness in DBC, and look where we opened. You know, we opened here 24, so we are 5% lower than the opening of 2023 on a basket of commodities. Then why should people fear inflation? And if people don't fear inflation, then they're going to believe the Fed's path is reasonable, right? All those dot plots are reasonable, and the market is always going to be pushing at the boundaries of those dot plots. So that is what I see. I don't see that DBC is going to suddenly give us a fright. I just think this continues, ranging here, because there's no reason really for it to come down. And until and unless I see DBC developing some sort of pattern which allows upside, I'm really not going to be a seller of bonds for very long, just tactically. But there you have it. If you believe that the Fed's path is reasonable, and if you believe that they will take the real rates down towards less than 1%, then gold tip right now makes sense that you buy tip and you sell gold, because you're looking for at least 1% off real rates in the short term, and you want to lock in the current 1.75. That's not this number, that's just a coincidence. The current real rate that I showed you that the 10s have, you want to lock that in, and then if you suspect that it's not going to happen, then you want to buy some gold. But in the meantime, you definitely want to prefer to be in tips rather than gold. And as you know, I sold all my gold and bought tips up here. To me, makes sense that this comes back down to here, at least, right? It just makes sense to me mathematically. Why would you want to be in something yielding you 0 when you need to lock in something that the Fed tells you is going to 50 and it's currently trading at 170? It might not go to 50, whatever, but that's your tendency, right? That's what you should be doing. So given that, it's not surprising that gold is doing very little, because there has to be a huge amount of switching into tips. I really can't see that gold is going to do anything. It might trade between 2080 and down towards this kind of level, 1960. I think that is basically what gold is going to do for the foreseeable future, until and unless the inflation path starts being questioned. Then gold can really perform. But until then, I really think it's an avoid. It's just leave it alone. It has no reason to move. What has a reason to move is tips and bonds and so on. And I don't think they are going to move until we get data confirming the Fed's dot plots. So if they are range bound, I think gold is range bound cubed. Before we look at equities, let's have a look what equities are actually doing against bonds. This is SPY shy, and it's not surprising that equities are outperforming it. This is SPY over IEF. That's, the 7 to 10 year area. And really it's doing very, very little. It's in the range that it's been for the past 2 or 3 weeks. SPY TLT is actually weaker, but if we look at ITOT over government, so the totality of the government bond market and against the totality of the equities, it's slightly higher, but it's at extremes and it's not really impulsive and it's likely to come back. So what I'm trying to tell you that I think that bonds and equities are pretty much the same thing right And unless you've got a very funny part of the yield curve that you are particularly long of or short of, you're not going to make a huge amount of money by being long of bonds or being long of equities rather than one or the other. So what I'm trying to say is that I think that they will continue to perform more or less in tandem over the weeks. I know that there is the strong possibility of a push towards year end, but that will be after Christmas. That will be the 27th, 28th, 29th, when they try to take the market higher. In the meantime, more of a possibility for equities of a technical correction than not. And on my clean chart, and I apologize if I've cut out these numbers, I'm having technical difficulties today. What to say about this chart? I mean, it's still bullish and it still is likely to go higher over time. I think this 47.12 level has caught it nicely in terms of balancing it, but 46.46 is really all you can see on the downside in terms of a technical correction. I really don't see that any data over the course of next week is going to give us much more than that. And then what we have is just the all-time highs. So I think the downside is limited. It's as limited in equities. I think the downside is limited in anything between 5 and 10 years, because just, there's all this money trapped that is going to come out. And the marginal, I don't know how much the marginal player in the money markets has and what percentage of the, I don't know, whatever it is, 7 trillion that's in there that will be, but it'll be, a pretty sizable amount. It'll be several $100 billion. And I think slowly over time, that money is going to rotate on any opportunity it's given out of 5.25% money for 3 months into 4.25% in 3s, 4s, 5s, if it ever sees them, and into equities. I mean, I just don't see very much of an alternative here for what that money can do unless it's already done it. And I don't think even 10% have been smart enough to do it in time. This is SPY over EWJ, so basically the ratio between the US stock market and the Japanese stock market in constant dollars. And I don't need to show you a Nikkei chart because I have for the past couple of weeks, but basically it has given up, and that is because of the FX component of it. And I think that this is likely to keep on rising over time, and that we're going to go and test these kinds of levels around the all-time, not all time, but the recent highs around this 770, which tells you that SPY still has a 4-5% outperformance against Nikkei. And if you have a look at Nikkei, you'll see that basically it's in a range between 32,000 and 33,500. So you have probably, 3-4% upside in Nikkei, and you probably have 4-5% more in SPY, or whatever combination that is. I think this continues, and if we change that actually to a weekly, you basically see that this is likely to break or test these 775 highs at some stage and then keep on going. So not the time to be long of Nikkei, I don't think. It's much more a time to be long of Europe and long of the US. Technical corrections are going to happen, and the 1.5-2% technical correction that I'm looking for in the next couple of days is just about all that you can expect, because equities are tied to bonds for the time being. You are more or less trading the same thing, and bonds are not going to go much higher in yield unless there is data, and we're not getting any data for the next couple of weeks apart from PC on Friday, which I can't believe is going to be a surprise to the upside, simply because oil and DBC in general has been so weak. So I really don't see what's going to make that number a strong number. So as long as DBC is weak, the likelihood of any kind of big equity reversal or any kind of big bond reversal is very, very low. So no great surprises in these levels. I think the only thing one can do is hope to see a move back down towards 46 and 16,200 and buy some options down there for the Santa rally, which comes the last week of the year. Very, very little likelihood without DBC or gold or something like that showing that the Fed's projected dot plots are rubbish and the inflation is going to be much higher than the Fed projects. For real rates to do anything but be contained and then look to come down towards the levels that the Fed has penciled in. I think I've made it very clear to you that I think real rates will come down as soon as the inflation levels that the Fed is projecting are confirmed. And then you could get big moves in bonds to the upside, and equities are likely to follow them simply on a multiplier basis. At some stage, probably less than bonds, but who the hell knows? I just think that we are in a range where the bottom in price, i.e. the top in yield, is much better defined than the other boundary. And it'll all depend on real data, and we are more real data dependent than ever. So here I've included the FOMC projections, and here I've included this CME toy that I showed you, so you can see how rich SOFR is, and that's why I don't think that something like the 1 year or the 2 year can go much further without real data, and therefore bonds can't go that much further because the yield curve, there's only so much that the yield curve can flatten. Thank you very much indeed, and tweet you tomorrow.